Good morning, Benzinga Zingers. We appreciate you for joining us today for ETFs Unlocked. So many times we've heard about ETFs and diversification, and the interest in actually ETFs is on the rise for several reasons. One of the key factors driving this trend is the appeal of diversification and the approach to investing, particularly as we face economic uncertainties. Now, ETFs can offer investors exposure to a broad range of assets, such as stocks, bonds, commodities, and they also provide a way to make sure you spread your risk across various sectors and industry. Now, this diversification can act as a risk management tool as well, which of course you want to make sure you're diversified because as we all seen, whether it's in 2008, or as we've seen in 2020 with COVID, if you had diversification, you were sitting pretty and you were just fine. Now, a lot of times the most popular ETFs that we've heard of are the SPY or the Qs, but there are a lot of other ETFs that you can take advantage of, whether it's on the airline space or whether it's in the EV space or all the other different sectors and investments that you can go ahead and make. With that being said, let's unlock some ETFs. All right, and then first up for us is going to be Dave Gilreath. Thank you so much for joining us, Dave. Apologies for that, Dave. Thank you so much for joining us.
Thank you. I appreciate the invitation.
Absolutely. Now, here's why I'm excited to talk to you, Dave, because, I've seen The Big Short, I've seen Wall Street, I've seen all these other, stock related movies. And I always pretend when I'm watching these shows with my girlfriend that when they talk about preferred shares and common shares and voting rights and this and that I know what I'm talking about. I know what I'm talking about, which is why I'm glad you're here to kind of explain it out to us, as you are the managing director, the portfolio manager, and the chief investment officer for Innovative Portfolios. Dave, if you could explain it to me like I'm five, what is it that your company does?
Okay, thank you. So, we have a couple of ETFs that we manage. We do some other portfolios as well, but a couple of ETFs and that are very focused in kind of narrow niches, I guess you might say. In your intro, you had talked about uncertainty, economic uncertainty, and I think that's a real thing right now. And to me, there's really a preferred share is nothing more than it's like a bond in a stock's clothing, which I'll talk more about in a second. But I think there's two big themes going into next year. One is the higher for longer interest rates that Chairman Powell has been talking about, and I don't know why people doubt him. He's been saying it for a long time. And the economic uncertainty, and now we're entering into a year of political uncertainty as well. So, as far as the higher for longer goes, I mean, income generating investments, whether that's bonds or preferreds or dividend paying stocks or REITs or utilities, whatever, they had a terrible 2022, and they've had a pretty mediocre 2023. I mean, so far in 2023, the aggregate AGG, the aggregate bond index, is only up a couple percent. PFF, the index for preferred, is only up about 5. Dividend payers like Noble, the dividend aristocrats, is up 1.7. So it's been a lousy year for anything other than the Magnificent Seven or these gigantic tech stocks. So I think though now is the time for these types of sectors, whether it's the dividend payers or preferreds or income generating things. And the main reason is because the Fed, they last raised their rates at the end of July. And so now we've been 4 months of interest rates at this higher level, and they're probably going to stay higher for a while. They might not raise it again because inflation seems to be going down. China's slowdown is really helping inflation in this country. But also with strong GDP, strong employment numbers that we've had recently, they might not cut either for a while. So I think we have to take Powell at his word. And that's one theme. The second would be uncertainty, and how you might want to invest in a sector that has some certainty to it, versus buying the hottest ETF out there that's chock full of these high-tech stocks that have a lot of uncertainty, quite honestly. And so one thing with certainty is income. When you get income, I mean, that's a certain thing. It's coming right into your account. And especially if you can get a tax advantage with that income, that's even better. So in the preferred space, preferreds have suffered a double whammy this year. Besides interest rates going up, which like a bond, like a teeter-totter, interest rates go up and the bond price goes down. The other whammy was the banking crisis earlier in the year. And, people don't even talk about that now, but it was a real deal, And so preferreds just really got hammered to a level they've only been at twice before. And that was in 08, 09, which was a lot different than today. And it was during COVID. And, the COVID sell-off with everything got sold off, but they were only cheap for a couple of weeks,
And you've got a couple of ETFs. You've got the Dividend Performers ETF, which is the ticker is IPDP. And then you've got the Preferred Plus ETF, which I believe is IPPP. That's 3 Ps in there after the I. Now, you know, what's cool about what you do is that you get to kind of see where the money is going. So I'll just kind of ask you from your perspective, from your insights, what are you thinking about the overall economy? Where do you think the money's going? And then I know you already touched on interest rates, but if you could touch on those two factors, that'd be great.
Yeah. So I think the economy is going to be better than most people think. A year ago, everybody was talking about a hard landing. Now they're talking about a soft landing. What if there's no landing? What if we just keep going?
Flying? Yeah.
Yeah. And, the U.S. consumer is probably in a lot better shape than a lot of people think. There's a lot of talk about credit card debt is hitting these high numbers and all this kind of stuff. But baby boomers have a gigantic, they have most of the savings out there is in the baby boomer space. And they are now, I'm a baby boomer. I'm 67 years old. I'm right at the peak kind of the baby boomer bubble, But a lot of them are paying off mortgages and they've got retirement savings and they're out, playing pickleball and having a great time and spending money and going to restaurants. So the economy, the U.S. economy is pretty good. And I think it will continue good. I heard a really great interview yesterday with Ed Yardeni, and he basically talked about how China's problems are a benefit to us because they're driving inflation down for us and we don't have to do it so much. So I think the economy is in a decent space for solid companies with growing earnings. And that is true in the dividend space. The ones that raise their dividends consistently, by definition, have good earnings or they wouldn't be raising their dividends, all the time.
Yeah, no, it makes perfect sense. And of course, you had so many individuals that talk about dividends and income strategies and all that other good stuff as well. Let's talk about your top picks. I mentioned that you have the Preferred Plus ETF, which is the ticker of IPPP. What are your top picks in that portfolio there?
Well, I mean, one of the preferreds, I think, is one of the last good places to get good yield from investment grade companies. Yields in the preferred space are around 6%. And the one thing that people don't really realize or think about is those are taxed as ordinary dividends. So there is a tax advantage to them. And they've been sold off. So there's a potential like slingshot appreciation, in my opinion. So if you look at, I had mentioned the preferred stocks have really only been this cheap two other times in history. Since they've been out trading, which really has been about 30 years. But if you can get a good yield from an investment grade company credit, now the preferred might not be investment grade because they're farther down the capital stack. They're not like the number one thing to get paid if the company goes bankrupt. But if you're buying a preferred in, let's say, a company like JP Morgan, and we own some JP Morgan preferreds in our ETF. I'm not sure if we own this particular one I'm going to mention, but there's JP Morgan has a preferred M, and I'm not telling you to buy this thing, but I'm saying you did $25 a share about 3 years ago, or 2.5 years ago, and it's callable at 25 in about 3 years, and it's trading right now at 19. So you're buying it at a discount, like 30% discount, and it's yielding almost 6%, 5.6%. So you've got this decent yield with a tax advantage, and you got 30% upside on this one preferred. And that's not just on this one, that's on a lot of them out there that are in a lot of these funds. So our Preferred Plus fund is really, it's an active fund. It's in my opinion, we call it plus because there's a little special sauce that we add to it. Currently yielding about 6.5. At the end of the third quarter, the SEC yield was 6.5. Right now, it's probably closer to 6. But we're very competitive against our peers, and I think it's because of the secret sauce, which is a we've done for years and years and years an option overlay on the S&P 500 that adds a credit spread on puts that adds a little bit of juice, a little bit of income. We try to add 150 to 200 basis points a year of income.
Nice.
And it has worked. I mean, it's you can compare us, to our peers like PFF, let's say the big 800-pound gorilla in the space, and go back 1, 3, 5 years. Well, we're going to be 5 years at the end of the month, at the end of December. But it's been a good, very solid performer.
Yeah, I'm glad you talked about the secret sauce, because there's a couple of questions I have since we have about 5 minutes left here. One of them, like we've heard so much about AT&T, right? Ticker T. Now I'm looking at the stock price, which is at currently about 16.15, which is the same exact price that it was out in 2003. And so then a lot of folks are like, hey, how am I making money? And I assume that's because of, one, the dividends, and two, the secret sauce, the option strategies and the credit spreads and maybe call options that you might sell. I assume that's where folks can go ahead and get their money, even though the actual stock price doesn't go up. Do I have that understanding correct?
Yeah, we don't own the AT&T.
Right. Sorry, that was an example. Thank you. Yeah.
We own the AT&T preferred. Most preferreds are issued by financial service companies, banks, insurance companies, REITs, things like that. Some of them are industrial companies like AT&T or, say, Ford, that kind of thing. But yeah, if you can buy right now, because preferreds have sold off, you have this slingshot kind of thing that could happen. Right. Win rates come back down, which I think they probably will sometime in the next, a year or two. But the secret sauce is basically just trying to add a little bit of income. Now the thing you have to give up is volatility. So like in our dividend performers ETF, we buy 50 dividend achiever stocks. So there's like 400 stocks that have raised their dividends every year for a decade or more. And so we buy 50 of them, and we tweak that a couple of times a year. And then we add this option overlay to it. And, options get a bad rap, but a consistent selling of option premium can add to return over a long period of time if the investor is willing to accept a little bit more volatility. So that's the yin and the yang that you have to reconcile with. But, volatility is, some people think it's risk. This week, Charlie Munger just passed away, and he was, the guy was a genius, but he basically said volatility is not risk, but risk to us, meaning he and Warren Buffett, risk is the risk of permanent loss of capital, number one. And the second risk is the risk of inadequate return. So if you can accept volatility in order to get a more adequate return, and we've proven over the last, since we've been doing this, that our returns are very solid versus our peers. So.
Yeah, I mean, volatility, and as a trader myself, I love it. I like the volatility, but of course, if I was swinging rather than day trading, or if you have, an investment in ETFs, I know folks that invested in different type of ETFs that weren't happy during COVID, but now they're doing just fine. We got about a couple of minutes here. Oftentimes I've talked to my friends about ETFs, so they always ask me like, hey, what should I invest in, this and that? I always tell them, listen, I'm not certified. I can't really answer that question for you, but ETFs are always a great way to go. The one thing that they always have a concern about is that, hey, I don't have enough money to buy ETFs and get a good return with dividends or fixed income and things like that. What do you say to folks that are saying, hey, I only have $2,000, only have $3,000. So like, what am I going to do with the dividends that I'm getting? Or do you often get those, questions or concerns?
Yeah. That's a great question. And there's an old saying, people will say, oh, is this a good time to buy stocks? Is this a good time to buy? Well, the best time to buy is when you have the money. That's the best time to buy. And
I like that.
An ETF, the beautiful thing about ETFs are you can buy one share, or in some places fractional shares. So even if you only have $100, you can buy it, and there's no commission at most places now where there's no commission, and so the barrier to entry there is no barrier to entry, unlike mutual funds and things like that have minimums and sometimes fees and whatever. So I think it's the greatest invention for the common man investor that's come across in the last 20 years.
Absolutely. Could not agree more. Thank you so much. I really appreciate your time, Dave. Thank you for joining us.
Thank you.
Absolutely. And you too, and you as well. And of course, that is Dave for hanging out with us here. We appreciate it. Now, let's go ahead and bring on my man, Aaron Bree, who's going to have a conversation with Yuri, and that'll be another good one as well. Aaron, what's up, my man?
What is up, Zunaid? How you doing, man?
I'm doing well. Be honest with me. Did you know the difference between preferred shares, common shares?
Something to do with voting, right?
See, that's the thing. So many, and I'm glad we had this ETF because oftentimes there's a difference. But anyway, I know you've got a great interview coming with Yuri, man. The show is all yours, pal.
All right, man. We will keep it rolling. Without further ado, let's bring on my man Yuri from Tema ETFs. Yuri. Yuri Kojamirian. Yuri, how you doing? How was that pronunciation, by the way? I don't know. I was a little iffy on the last name there.
No, it's perfect. It's all good. You have to commit to the last name. That's the key.
Kojamirian. All right, got it. Committing now. All right, with Tema ETFs, before we get started, Yuri, why don't you just tell us a little bit about Tema?
Yeah, absolutely. Really happy to. So Tema, we are a new ETF issuer. Started about 2 years ago. We have 6 funds in the market, and we're focused on thematic ETFs. So what we're trying to do is kind of be different in our approach to themes. So thinking about long-term structurally growing themes. And then we use experts effectively to select the securities that go into these themes. With the idea being that we want to create precise, focused portfolios with high quality companies that are taking advantage of this structural trend. And as I said, we have 6 ETFs in the market. We just launched one last week. And we're looking to build over time and focus on these kind of long-term structural areas of the market.
Got it. So can you explain, I guess, Yuri, the core issues in thematic investing that Tema aims to address, particularly in contrast to common problems seen in more passive funds?
Yeah, absolutely. So I think Tema set out on a mission to try to address some of the problems that we see in thematic investing in general. Most thematic investing is done passively. I think that's kind of one of the problems. But if we even just begin with the themes that are selected, so often issuers issue themes that I would sort of, in a nice way, call fads or areas of the market when it becomes quite hot and it's easy to present a marketing message. But from an investment perspective, perhaps that's not the right time to be allocating to that particular theme. And we've seen that time and time again. We obviously saw that in 21 with areas like things like metaverse and the launch of a lot of technology-focused ETFs that are around sort of what we'll call questionable themes. And I think what we're trying to do is be really thoughtful about the themes that we select. We want to be in structural, long-term growing areas of the market where we really believe there's an investment merit over multiple decades, not something that's going to come and go or maybe sort of be subject to the hype cycle. So I think that's the first area that we're focused on. The second problem we see is precision. So what tends to happen is to hit the theme or the theme's name, it's actually quite difficult to select the securities. And often what we see, especially passive index, where there's not a lot of resource being put behind security selection, is it's not very precise. So the theme doesn't really match the stocks that are within a portfolio. So to give you an example, there's almost 390 different ETFs that hold Microsoft and NVIDIA in the top 15 holdings.
Right.
Now, they're great companies, right? But the point is that not all 380 possible different themes can be related to those 2 companies. And I think that speaks to the challenges that the industry has in terms of expressing, picking the stocks that express the theme perfectly. And that's something that we're really trying to address here at Tema. As I said, we have expert fund managers that look at the space, that become experts in their universes, and they really know the companies that are expressing the theme in a purest possible way. And especially as that theme works over time. And our investment team has kind of over 100 years of experience looking at this. And that's kind of what we're trying to try to put out there into the market. And then the third problem that we see is the quality of the companies. So it's sort of the opposite problem. To try to hit the name on the theme, individual fund issuers will maybe sacrifice the quality of the companies. So sometimes have loss-making businesses, really poor capital allocators, sometimes outright frauds just because they have the right name and the right exposures in their revenue lines. And so what we're trying to do is, again, weed out these quality businesses by having experts select the stocks within the portfolios. And that's really what Tema is about, and trying to solve those three problems.
So, Yuri, I guess let's, and I've definitely noticed that before, where I've been going through top holdings of different ETFs and different funds, and it'll be like a very specific, it'll be like natural disaster cleanup ETF, and it's supposed to be only companies that help in natural disaster cleanups. And then you'll see Nvidia in the top 10, and it'll be like, well, Nvidia is using AI to determine where the next natural disaster happens. It's like, okay, well, I guess maybe that makes sense. But either way, like you see the same names in the top 10, it seems like, in a lot of different ETFs.
Yeah,
But
this is it. It's a big problem in the industry. It's just lack of precision. And to really get it right, you need someone 24 hours a day, 7 days a week, looking and understanding what the theme is, what are the best companies to express it, and how it evolves over time, which is really important as well.
got it. Well, let's talk about some of the specific themes right now. I was exploring. I guess let's start with the American reshoring ETF. Can you talk about some of the key factors driving the reshoring trend in the United States, and how does the reshoring ETF navigate this trend?
Yeah, absolutely. So reshoring is a perfect example of an ETF that's quite difficult to index, right? So immediately you think, okay, how is it that I come up with a list of companies that are benefiting from manufacturers bringing manufacturing back to US shores? And this is really being driven by the private sector. I think what we're seeing out in the world in terms of the deglobalization, a lot of the risks, trade wars themselves, I think companies are increasingly becoming a bit scared of the way their supply chains are spread across the world. And I think they're realizing that the decision previously, which would have made a lot of sense to offshore manufacturing to lower cost destinations, when the differential in wages was 40 times, that makes a lot of sense, right? But the differentials have closed. They're maybe sort of 3 times. And I think what companies are realizing is there's a lot of risk having your supply chain spread around the world. And I think the pandemic, for example, but other issues as well that have arisen since have shown that if you can't deliver the goods to the customer, you're never going to book the revenue. And so what companies are starting to do is move manufacturing back to the US. And this is really being accelerated by government initiatives like the Inflation Reduction Act, or the Infrastructure Act, or the CHIPS and Science Act, which together really are pretty formidable package of about 1.8 trillion of spending to rebuild the manufacturing base in the US. And reshoring, our reshoring fund, is squarely in the middle of that, trying to find the companies that are going to benefit and be the winners of that particular trend. And by the way, we think this trend is multi-decades, because once companies make these decisions, it's something that they don't do lightly. They're making manufacturing decisions for the next 20, 30 years. And we really believe that this is going to continue going for many years. And the government part is just an accelerant of that. So we're trying to find the companies that are best placed to win at this particular stage. And as that permeates and the industrial base in the US gets rebuilt, who are going to be the winners of the future as well.
Yeah, and that one might actually be one where, like, Nvidia or something, because I know a lot of those chip companies are trying to bring manufacturing jobs back to the United States. So you might actually see some of the semiconductors, that are doing the
manufacturing of semiconductors is a really important strategic objective for the US, but also it's a decision, right? They're realizing that you want to be closer to the consumers. You want to build that technology capability in country as well. And a lot of companies, like, for example, Nvidia, have basically relied on manufacturing in Asia, and that served them quite well in terms of cost and in terms of technological capability. But they're realizing actually it'd be helpful to have a diversified manufacturing base. So Nvidia is not actually in the fund, but the manufacturers of semiconductor equipment and the fab manufacturers themselves, like companies like TSMC, are building huge plants in Arizona, are part of the theme for sure.
Yeah, 100%. Well, Yuri, we've been having a great conversation so far, so time's kind of flying by. We've only got about 6 minutes left, so I want to make sure we get to the rest of the themes that you guys are exploring. Let's jump to the cardiovascular and metabolic ETF, HRTS. What challenges and opportunities are highlighted in the metabolic diseases sector, and how does HRTS position itself in response to those dynamics?
Yeah, so HRTS is our newest ETF. We launched it last week. It's managed by a portfolio manager
brand new.
Who's got brand new, who's got 30 years experience. So he's been around the block. 25 years experience, both working in the medical industry and investing in equities in the space. And he really understands this. And as you know, biotech and life science investing is quite risky. So you really need to be an expert and understand what's going on. And cardiometabolic disease, I think, would sum it up with 3 main points. I think the first one is it's responsible for about 1/3 of all deaths globally. So it's a huge problem on healthcare systems and patients' lives. But there's a lot of innovation that's going on, not least drugs like Ozempic or Wegovy that have launched in the US that have really shown massive benefits in terms of cardiovascular health, in terms of losing pounds and the impact that has on cardiovascular health. That has been a really watershed moment, but there's a huge amount of innovation that's going on in the background that's created massive opportunity in terms of new investments. And this is set against biotech, which has had one of the worst down cycles it's ever had. We're basically on track for a 3rd down year in major biotech indices. And I think it's really telling you have this massive valuation opportunity and a lot of innovation that's happened over the last couple of years. And that's not really being captured by the market. So we think it's a great and exciting area in terms of really saving and helping patients' lives, and lots of innovations happening against a fantastic valuation opportunity in the market. That's basically HRTS to sum up.
There you go. And you have a chance right now to get in on it on the ground floor. Again, just opened up last week, ticker HRTS. Moving along, Yuri, just in the interest of time, let's go to one that, I don't know too much about luxury goods right now yet, but maybe as I, get older and maybe I'll be able to afford a few more Rolexes and things like that. But let's talk about the luxury ETF, ticker LUX.
Yeah, so LUX is focused on luxury goods and services. And again, it's a perfect expression of the purity that we were talking about in thematic investing. I think if you look at some of the indices that the likes of S&P and MSCI have constructed of luxury goods, what you find is a lot of it is, about 25% on our estimates, it's full of like mass consumer goods, like Nike or Lululemon or some of these other companies. And some of the pure luxury goods companies are underrepresented there. And so it's about, even in a space that might seem obvious in terms of the companies that go into it, having an expert look at the space and understand it. The other thing is there's a remarkable dispersion of returns within these stocks. So you really want to know which ones are going to be the winners for the future rather than the ones that maybe have won in the past. But luxury goods, it's a fascinating industry. And I think it has a lot of the hallmarks, in terms of financials that rival even the technology companies in the US, things like return and growth rates. And the reason is it's about craftsmanship, quality, heritage. And this allows companies to charge higher price points and be very, very profitable because of it. As you all know, Rolex, as an example, as a private company, is synonymous with kind of quality and prestige. And I think there's a lot of people that want to buy these things, but the supply is actually quite limited. And it allows these companies to charge higher prices and actually make a very fantastic return as an investment and as a company. So I think if you think about that, it's why we believe luxury goods is a really nice core holding for a long period of time, because you can play on these trends. And as the world gets richer and new markets open up, like in the Middle East or even in the United States, where if you actually look at it, it undershoots relative to the number of wealthy individuals in the US in terms of its consumption of luxury goods. So we think, it's structural, it's long-term. You've got to have the purity of exposure to the names within the space, and an expert to navigate some of these dispersion of returns. And that's why we're sort of quite bullish on luxury goods long-term.
Yeah, and I guess so, Yuri, I'm curious, like, what would be the benefits? Because right now, I know when I think of luxury goods in terms of just capital markets, I think of, LVMH as being the kind of conglomerate which owns a bunch of different luxury brands, whether you're talking Gucci, all these different things, LVMH. What would be the benefit to an investor holding the Lux Fund over LVMH stock, which again already owns all these different brands?
Yeah, it's a great question. I mean, obviously LVMH stock, the interesting thing is actually not accessible necessarily to a lot of investors, partly because they don't have, it's a listed overseas. So sometimes some trading platforms don't really allow you to hold overseas stocks.
Right.
But even for the investors that have that, it's nice to have the diversification of returns, because if you look over the last couple of years, yes, it's been a stellar performer as well, but there are lots of other companies that have done better in terms of percentage returns. And so I think it's about kind of diversifying to other areas. Particularly, we're seeing like a shift towards luxury services, and that's an interesting area. LVMH is getting in there, but as a conglomerate, it's harder for them to get into, getting that pure play exposure to those areas. And that's what we're sometimes the sands shift and LVMH could be a winner, but there are other companies that will win more and get a better return from it. Of course, LVMH is a core holding in the fund. It's a fascinating company. It's built up over 30 years through deals, controls 75 brands. It clearly shows you what can happen. And there's a few really interesting opportunities in terms of kind of other companies trying to build these conglomerates, Kering being an example, or the acquisition we've just had of Tapestry of buying Coach in the US. Other companies are trying to replicate that success. And I think that's what the future of the fund is, right? Finding those opportunities that are going to build something very similar to the LVMH to replicate its success and hopefully have the returns that it's delivered over time as well.
Got it. Yeah. I mean, it's like you said, it is a very interesting company. I think it's a very interesting sector in general because it seems like it just, continues to grow and grow and grow. More people are buying more and more luxury goods every year. Well, Yuri, I mean, this has been a great discussion. I'm glad we got a chance to touch on all the major themes right now that Tema is exploring. Is there anything else you'd like to add to our investors before I let you get on with your busy day?
No, I mean, that's it for me. As I said, you can check out all of the funds at temaetfs.com. We have lots of information about them and produce a lot of interesting research for people to read as well. We kind of pride ourselves on that. And really, it's just the kind of core points, long-term structural themes, not fads, run by experts with over 100 years experience in the market.
Well, I love that. I love that you guys have some insights and things to read on the website too, because that's one of my favorite things to do is to just dive into different findings and what people are seeing. So again, Yuri, thank you again for joining us. It is Tema ETFs. You can go to temaetfs.com to learn more. Enjoy the rest of your Thursday, and I hope we get to chat again soon.
Thanks. Bye.
All righty, guys. That was Yuri Kojamirian from Tema ETFs. Again, go check that out. They've got 3 different ETFs that we discussed: LUX, their luxury one, HRTS, which is their cardiovascular and metabolic ETF, and then RSHO, that is their American reshoring ETF. So again, cool company exploring some cool themes if you guys want to learn more. I'm going to kick it to my man, Money Mitch, right now, who's got another very interesting interview coming up. And don't worry, I'll be back right after Money Mitch here in about 15 minutes.
Joel Schulman, founder, CEO, and CIO of Entrepreneur Shares. Let's bring him on. Can you provide evidence supporting ER Shares Entrepreneur's factor as compelling investment strategy, particularly when in comparison to traditional market-oriented approaches? And how has that performed over the last 2 decades?
Right, thanks. Well, that's sort of the heart and soul of what we do. And we invest in these publicly traded entrepreneurial companies. And we were one of the first thematics, period. I'm an academic. I'm a professor at Babson, tenured full professor at Babson College, the #1 school in entrepreneurship, and also a fund manager. I've been doing this for 20 plus years. And we invest in publicly traded entrepreneurial companies. And what we mean by that, it's more than just a founder CEO. And we were the first to really talk about the founder CEO index. But it's more than that. When you think about the growth, not only in the US, but the growth globally, and this is true for hundreds of years, maybe thousands of years. But you think anecdotally, just the last couple hundred years here in the US, we had Rockefeller and we had Carnegie and we had Henry Ford. These are all entrepreneurs. Even in the last 30, 40, 50 years, you had Sam Walton from Walmart, you had Steve Jobs from Apple, you had Bill Gates, you had Elon Musk. These are all great entrepreneurs, and they create the growth of society, and they're primarily concentrated in a handful of categories. And we've outperformed over a period of time. We've significantly outperformed pure benchmarks, and we have various indices and so forth that are passive, and we also run active funds too.
Well, you guys have many different products and services that you guys offer, but let's talk about, of course, the top 2 in the ETFs, right? What distinguishes ENTR, of course, Entrepreneur ETF, and ERSX, which is the next gen? And I would love to know the distinguishing factors between those and terms, of course, for the focus here, the methodologies and the targeted market segments that we're looking at. And of course, how do they cater to investors seeking exposure in this space?
So there are a lot of copycats in this space. We were the first to be in entrepreneurs, disruptors, innovators. We were the first ones to do it. Others have come along and actually raised a lot of money in the space, but we were the original group in this category. And ENTR is designed for those who are looking for an alternative to a U.S. large cap space. And so we don't invest in Apple, we don't invest in Microsoft, we stay away from the mega caps, which in a year like 2023, we still outperform the market despite the fact that most of the performance came from 5 to 7 mega caps. But we do it because we have the next Microsoft, the next Apple, the next Tesla. So we're involved in many of these disruptive stocks, disruptive industries. We primarily gather our investments from 4 sectors: from IT, investment information technology, from healthcare, consumer discretionary, and communication services. So the bulk of our assets are in that space. We track very closely to the Russell 1000 growth. So people who are looking for an alternative to that index would find a good fit for us. We're much less aggressive than some of the other disruptor innovator funds because they go across varying market caps. Some of these competitors will go into mid caps and small caps and nano caps, even and micro caps. We don't do that. So we have a U.S. large cap category for ENTR. We also have small cap mutual funds and a global mutual funds, but the ENTR is a U.S. large cap ETF, which has very strong analytics compared to other U.S. large cap growth benchmarks like a Russell 1000 growth. Now, ERSX is it's a polar opposite. So it's a small cap for non-U.S. product, which includes not only the developed international markets, but also the emerging markets. And that's a much tougher category to compete in because now we're looking at globally outside the U.S. And our database includes 66,000 publicly traded companies around the world. We get from Bloomberg and CapIQ, and we screen for a number of criteria that allows us to ascertain whether a company is entrepreneurial or not. So there are a lot of proprietary data we've gathered. We've got over 20 peer-reviewed publications. These are at the highest academic standards that we've got, and nobody else has research that compares against what we've done over the last over the last 30 plus years of Babson, which again is the #1 skill in entrepreneurship. And that's what we have as competitive edge.
Can you elaborate on Entrepreneur Shares' emphasis on founder CEOs and how that presence impacts the performance of entrepreneurial companies, and how ER Shares identifies and leverages this factor in its investment strategies? Of course, we don't want the secret sauce, of course, because that's what makes you guys what you are. But of course, let us know some of those factors that comes into this.
Right. So we actually, when we first started, we were reluctant to mention founder CEO, and then we let that spill out, and then now it's taken as common knowledge. But it's more than just founder CEO, because you have to look at what these entrepreneurs are doing and how are they different from. There are a lot of founder CEOs out there, but the compensation metrics are different, their holdings are different, the way they invest are different, in terms of whether or not they're pursuing M&A or they have dividend yields and things like this. So our companies tend to be different in that we're primarily a growth-oriented fund. So again, we don't have any utilities. We have a handful of financials, but it's primarily the fintech that we would have in financials. We have very few materials. So again, we're concentrated in IT, healthcare, communication services, consumer discretionaries, and these are investors. These are leaders who have a team that's tight. We look at not only the way they're compensated, but we also look at their holdings and whether or not they're selling stock or buying stock. We look at whether or not there's turnover among senior staff. We look at how they're growing and whether they grow and they're accretive, whether they're expanding their margins. Some people, by the way, the corollary to entrepreneurs, bureaucrat. And so we actually look at them as a mirror image. And so the way they behave, they tend to have very short durations. They're in their positions 3 to 5 years. And as a result, because the bureaucrats have a shorter duration, their orientation to how they manage their jobs are different. So they're willing to pursue growth for the sake of just getting a bigger company to raise their compensation. whereas our constituency tends to make most of their wealth. They get paid biggest, but they get paid last. And that's really important because they're aligned with the interests of the shareholders, which includes us. And so, in fact, I wrote an article years ago that led to the billionaire index for Forbes, and it was the rich get richer and so can you. So simply modeling after the behavior of these successful entrepreneurs, you can actually make very good money. And in fact, we were among the first to get NVIDIA. We got into 2005. And since 2014, that stock has gone from $5 a share to 500 plus. So that's a 100x multiple in less than 10 years. And so we have stocks like that. And we're looking for that. We're fairly confident that in our portfolios globally, we have the next NVIDIA, just as we have the next Apple, the next Tesla.
Yeah, it's truly impressive of what the right entrepreneur behind the company can do, right? And especially being the founder in those situations, it's so important to try to give really the best benefit right back to the company, right? There's very few CEOs that I just purely buy into, but I love catching moments where I see CEOs really dig down and want to see their own company succeed, whether it be by big insider buys and things like that. That's what I want to see, because truly at the end of the day, that's what we're all looking for, is the leader in the company really trying to give back to the shareholders and get back that value. Let's get into innovation and disruptions, of course. How does ER Shares identify and capitalize on disruptive innovations within the industries led by entrepreneurial minds?
Right. So to your earlier point, management, leadership matters. In fact, we wrote a publication that was widely distributed called Leadership Matters. And so there are a lot of variables that analysts look for that impute leadership. But you can't go to Bloomberg or Capital IQ or FactSet and identify or screen based on entrepreneur. And so what we have to do is cobble together a number of criteria, a number of factors that imply what it means to be an entrepreneur. And in fact, when we look at the entrepreneur factor, we actually do factor analysis. We've done it in Bloomberg, and our data is there for people to look at, those who have access to a Bloomberg. And they'll see when they do a factor analysis that you put everything in there. You adjust for size, you adjust for sector, you adjust for leverage, you adjust for dividends, you adjust for growth or value, you adjust for country. You put all these things in, and over a long period of time, you'll see what stands out is a selection effect, which is the factor associated with the manager, which is significant. And you'll see, if you can show the audience our slides on the entrepreneur factor, you'll see that it stands out supreme over a long period of time. And so we're very proud of this distinctive factor. And again, it's really a management factor. At the end of the day, rather than looking at size or leverage or dividends, it's management. And so we do a summary of management, which compiles a lot of proprietary data that we put into it.
Yeah, definitely something to look into, team. I'll definitely check out that on Bloomberg. Let's get to the disruption side, of course, disruptive innovations within the industries and how that, of course, can be something that you guys can capitalize on.
Right. So when you think about disruption, whether it's AI or healthcare, there's a lot of data, a lot of innovations going on right now, and we're seeing for example, during the COVID era, we saw a lot of money, a lot of speculative money going to space, some of which has transpired well, and some it didn't necessarily blossom. But at the end of the day, we saw a lot of capital going into a few key sectors, and that was healthcare and IT. Now, traditionally, IT has been the mega growth area that's really sort of blossomed, and we saw communication services and tech, and over the last 10 years, Tesla, Amazon, Google, Meta, all these were tech oriented. But there are a lot of healthcare companies now, and investors may not be thinking about it necessarily in this context. But when you think back, in the last few hundred years, the life expectancy of people in developed markets has increased by 50%, and in emerging markets, it's increased by 100%. Now, humans have been on the planet for thousands of years, but it's only been the last 100 years that we've seen significant growth in both of these areas, both the developed and less developed markets. And we've got all these innovations going on, which are being funded for disruptive, innovative technologies. And a lot of it, AI is now capitalizing. AI crosses over because you're seeing AI not only in tech, but also in health tech. And you're seeing a lot of innovations being created, which is going to take us to, for the next 50, 100 years, some extraordinary growth models, which is going to have significant impact. In fact, one of our funds, our small cap fund, is called Impacts, IMPAX, because we not only our entrepreneurs not only create growth for their shareholders, they create a lot of jobs. And in fact, most of the jobs, and this is a well-known statistic, most of the jobs are from smaller companies, but it's the small entrepreneurial companies. And even among the large cap, among the S&P 500, it's just a dozen or so large cap companies, almost all exclusively these mega cap entrepreneurial companies, which are contributing to the growth of jobs. And globally, it's always been the entrepreneurs. So our entrepreneurs are innovators, they're disruptors, they're growing revenues, they're improving the lives of people in their communities through creation of jobs and wealth. And we think it's a very exciting space to be in.
Yeah, considering, of course, perceived higher risk when we talk about entrepreneurship ventures, how does ER Shares manage the risk within its investment strategies, and especially amidst this rapid, technology advances and market changes?
So it's important for us to be sensitive to the benchmarks we're being compared against. And so when you look at the other disruptor funds, and we have various filters that also look at quality of earnings and growth and so forth. And our corresponding beta, and you'll have statistics that you can show the audience as well, on risk-adjusted basis, where our correlations are very high to our benchmarks. Our betas are relatively modest compared to other peer-reviewed, compared to other peer benchmarks in the innovative, disruptive entrepreneur space. And it's because we're being careful to have risk metrics associated with the composition of the portfolio with similar sectors and weights and so forth. And then we also do overlays in various periods of time, whether we shift more towards quality earnings or whether we shift towards a more speculative, higher growth portfolio. And so with interest rates, in an interest rate environment where interest rates are rising, we'll shift to higher quality and shorten the duration of our assets, meaning that we'll get stocks with companies that are more cash flow oriented and getting most of the benefits in the near term. And when interest rates are declining, as they are now towards the end of 23 and potentially through 24, we go out longer duration, which means we can have the more speculative companies and go more towards smaller caps and even internationals. And so this is an important criteria. And as you may know, I as an academic, I'm also in the media quite a bit on major media stations talking about capital markets. And so we're looked to for a voice in terms of what our expectations are on the macroeconomics. And so we're very sensitive to whether macroeconomics will allow us to be to be longer duration, more speculative, or shorter duration with more focus on earnings quality. So it's very important to be sensitive to how you want to compose your portfolio.
Joe Stolman, founder and CEO, CIO, Entrepreneur Shares. And where could investors learn more about this interesting strategy? And who should they be reaching out to maybe ask questions, Joel?
Well, they can always go to info@ERShares. That's info at E as in Edward, R as in Robert, shares, SHARES.com. They can always reach out there. They can call us. They can go to our website at ER Shares or Entrepreneur Shares. They'll see our data. We're available with our 2 ETFs, virtually anywhere. Our mutual funds, which we have 2 impacts, and we have another one, NTIX, which is a global fund. Impacts a small cap. Those are on many platforms, and so we're delighted to answer whatever questions people may have for us.
All right, guys, that was Money Mitch. Great interview there. We're going to keep it ticking. We've got some very exciting companies still to come up. I'm going to be speaking to my man John from Sprott. So without further ado, let's welcome Mr. Chimpelia on the show. All right, John, how are you doing today?
Hey, great. How are you doing?
I'm good. So before we get started, why don't you give us just a brief overview of Sprott for our audience before we get into everything?
Yeah, sure. So thanks for having me. Well, Sprott has been around for about 40 years, and we're based in Toronto, Canada, with offices around the US. And really what we're best known for are natural resource investing in physical assets, physical commodities like gold, silver, platinum, palladium, and more recently uranium. And we have a whole suite of different ETFs and active strategies that are focused on all things related to metals and mining.
Cool. Yeah, you're up in Toronto, not too far from us here, Benzinga. We're located in Detroit, so just a few hours of a drive. And I guess, John, again, before we get into it, do you want to tell us a little bit about yourself and your own personal background?
Yeah, sure. So I've worked in the asset management business for shockingly 30 years now. So it's been a long run and journey, and I've exclusively focused on essentially the buy side of the business, which is the asset management business. Worked for very, very large financial institutions, and for the last, I guess, almost 14 years, I've worked at Sprott, which is a boutique manager. We manage about 25 billion US dollars, so it's a very entrepreneurial type of environment. My background has been mostly in product development and portfolio management, and it remains a fun gig in a very dynamic industry.
Cool. Yeah, it sounds awesome. Let's get into. I want to talk some precious metals, some gold, silver, etc. What are your thoughts on the current U.S. dollar to gold correlation? Where's gold heading in your opinion?
Yeah, well, gold is definitely getting a little bit of its swagger back. And obviously last year it had a challenging back half of the year. But in the last few months, it's been kind of slowly kind of grinding up this kind of staircase. And we feel as though it's finally getting ready to test new highs. There's been kind of 3 tests in the last, I guess since 2020, where we've kind of punched through the 2000 mark, but haven't really been able to break through it convincingly. The US dollar softening in the last few weeks in particular has really helped gold. And that is obviously on the back of expectations that the Fed is finally done its tightening cycle, and that the trajectory for interest rates in 2024 is clearly going to be down. Some commentators are modeling that the Fed will actually cut interest rates at some point in the first quarter. That might be a little aggressive, but I think definitely we're going to see a number of interest rate reductions next year. That is clearly going to put more downward pressure on the US dollar, and gold, typically will benefit from that. The other thing I would mention is that when you look at the return of gold in a number of other currencies, major currencies around the globe, it's obviously done incredibly well over the last few years. The return of gold, obviously in US dollars, has been muted because the dollar has been so strong. But when you look at it in terms of investor experience, around the world, it's been very, very strong.
Yeah, and I mean, right now we've been hearing a lot more and more about that correlation and gold in general, like you said, getting some of its swagger back. You have a physical gold and silver trust ETF. What is the strategy for them? What are your top picks from each? Any individual names you'd like to discuss?
Yeah, so Sprott manages a number of physical gold and silver trusts. These are closed-end funds that trade on the New York Stock Exchange. So we have a fund that invests exclusively in gold. Those are 400-ounce bars. We have another fund that invests exclusively in silver in the form of 1,000-ounce bars. And then we have a fund that commingles the two, which is about 2/3 of the value is right now allocated to gold and 1/3 silver. They're very popular funds. They're all kind of $4 billion, and our gold fund is $6 billion. So they're very well-established funds, very liquid, and they really give an investor the opportunity to invest in physical metals without obviously the inconvenience of having to go and buy physical metals yourself, figure out how to store them, figure out how to insure them and whatnot. So they're very popular vehicles for investors that are looking to, own physical metals through the convenience, obviously, of an exchange listed offering. And they've proven to be very popular with our investors over the years. So we have 3 tickers: PHYS, CEF, and PSLV are the 3 tickers.
Got it. And so, John, the overall kind of transitioning here from gold and silver to a different, precious metal, lithium. The overall lithium market is going through a consolidation. What do you think about that right now? Do you have any insights about the lithium market right now?
Yeah, I mean, lithium has obviously been a very popular thematic over the last few years as people, are basically embracing electric cars around the world. A few years ago, it was pretty rare to see a Tesla driving around, and in some cities, obviously, they're everywhere now. So we are seeing growing adoption of electric vehicles. We are seeing incredibly high, penetration of new car sales in some markets. And I'll give you just some examples. Like in places like Norway, 85% of all the new cars are electric today, which is astounding. But it's still a small market. Let's go to a big market like China. About 1 in 4 new cars sold in China today has some kind of a battery in it. They're clearly the number one in the world in terms of just deployment of new electric vehicles. And the other parts of the world are playing catch up. And most of these vehicles, irrespective of what battery chemistry they use, the common element across them all is lithium. That is your electrolyte that basically moves energy between the cathode and the anode in the battery. Lithium has essentially gone through kind of a huge upcycle, and now it's going through a bit of a down cycle in terms of its price. We saw huge gains in the price of lithium in 2021 and 2022. It was by far the best performing commodity in the world. The price of lithium went from about $20,000 a metric ton all the way up to $84,000 a metric ton. So it went parabolic. That was really on the back of a supply shortage when new car sales had really spiked. This year, we've seen a pretty healthy correction where the price has gone down to about $20,000 a metric ton, believe it or not, as we've seen some moderation in the growth around the world in EVs. I think a lot of this has to do with the fact that 85% of new cars are financed, and we know financing rates for durable goods and mortgages and whatnot have gone up substantially in this tightening cycle. So that's definitely taking a little bit of the momentum, the growth momentum, say from like 40% annual growth in sales. We're probably going to be 28 or 30%. So still growing very healthily, but the growth is moderated. And that's really taken a lot of the steam out of the lithium price. It's typical to go through these kind of restocking and destocking cycles with the car companies. And right now, lithium is just trying to find its footing. If you take a step back and look at the next, say, 5 to 10 years, the amount of lithium that we're going to need to enable the transition to electric vehicles is astronomical. It's the number one growth projected amongst all the different battery metals you have in the world right now. And that's just because prior to the advent of electric cars, we really didn't need a lot of lithium. And now with this shift to electric cars, that's really driving the anticipated demand in lithium.
Yeah, I mean, you went from like never hearing about lithium, and now I feel like I hear lithium ion battery like 3 times a day. So it would only make sense, I guess, that lithium continues to become more and more valuable as that transition toward electric cars, happens. In Sprott's lithium mining ETF, ticker LITP, who are your top picks? How do you see the lithium market? Or I guess can you talk a little bit about those top picks and their outlook over the next couple of years?
Yeah, so we designed LITP really with the goal of providing investors with pure play exposure to the companies that are actually producing lithium. And lithium really comes out of the earth in 2 ways. It comes out of hard rock, so these are called hard rock deposits, and it comes out of brines. And brines are basically salty waters. You see these big flat in the salt flats in the lithium triangle in South America, which is Chile, Bolivia, and Argentina. You see these big evaporation ponds, which are basically salty water that contains lithium. They wait for the water to evaporate through natural sunlight process, and they extract this lithium, which just looks like a white powder. The fund is really designed to give exposure to the largest lithium producers in the world. And by the way, there aren't that many lithium producers in the world, believe it or not. There's a handful of companies that are producing lithium today. What the fund is primarily consists of in terms of the number of companies would be companies around the world that are developing projects to actually produce lithium in the coming years. So these are development stage companies and exploration companies. And, you know, given the lithium price spike that we saw 2 years ago, it's fair to say that there's been kind of a lithium race going on in terms of companies trying to find deposits around the world, because the OEMs, the car companies, are very focused on ensuring they have security of supply of lithium, because they don't want to build, you know, these multi-billion-dollar manufacturing facilities for batteries and assembling cars if they don't have all the critical minerals. And it's not just lithium that they're focused on. They obviously need to ensure they've got supplies of nickel and cobalt and manganese and graphite and copper. Those are all the key minerals in addition to lithium that car companies are very focused on right now. So it gives you a way to play the thematic without kind of taking individual company risk. This is why a lot of thematic ETFs have become very popular with investors. They don't want to pick and choose, you know, which ones are going to be the winners and losers. It can be challenging, especially in these, you know, newer industries. And so the fund is a nice way to get kind of a diversified exposure across the whole supply chain, kind of top to bottom.
Got it. And I guess, you know, John, I'm curious, when looking at some of these ETFs, like a gold or lithium mining ETF, what are the benefits for an investor purchasing shares of these ETFs or getting exposure to the mining companies as opposed to just buying the commodities outright?
Yeah, well, we find in many cases it's very difficult to get exposure to the commodities themselves, either through some kind of a physical commodity type of vehicle. We obviously run a number of these, or even through the futures markets. Many of these commodities are nascent, meaning they're very early stage and still immature. There aren't active futures markets behind them. So, you know, things like lithium and cobalt and uranium, believe it or not, the affiliated futures contracts are very liquid. So in many cases, investors opt to choose the part of the market segment that is more liquid, more diversified, and those are the public companies that are actually mining for these critical minerals. So many cases, investors opt to go upstream in the supply chain, which are the primary producers. And again, as I said, you know, these are technical, you know, kind of investments. You've got different kinds of deposits around the world in different jurisdictions. And for most investors, there's just way too much work to try to figure out exactly, you know, which companies, individual companies do I pick? And this is, I think, why ETFs generally have become so popular with investors, particularly in these different thematics, is that it's just easier to get broad exposure to the thematic and kind of ride the sector up and down through a more diversified approach.
Got it. Well, John, we've only got a few more minutes left, but you know, we touched on gold, we touched on lithium. I want to talk about copper for a second. Copper is actually my favorite precious metal, if you want to call it that. But you have a copper ETF as well, COPJ. Can you tell us more about the copper ETF and what differentiates it from other copper funds out there?
Yeah, sure. So, I mean, everybody understands what copper is. We've been mining copper for, I think, 8,000 years. And it obviously is very well integrated in our, you know, day-to-day lifestyles. Where copper is getting a lot of attention is its increasingly important role as the world moves to electrify more things in our lives, whether that's transportation, cleaner forms of energy like renewable energy. Everything will require copper because it's an incredible conductor of electricity. So if you think about the copper market that's been operating for thousands of years, I think it's safe to say that all the easy stuff's been found. And if we want to move to this cleaner grid system, more, you know, transmission, more EVs, solar power, wind, we're going to need a lot more copper. And so the big challenge in the world right now is trying to find the mines of tomorrow. And that's really what this particular ETF is designed to do. It's trying to find the companies that are either early stage development companies or exploration companies that are trying to find new copper mines. And that's it's definitely been an interesting area. It's garnering a lot of attention, and it's also been very active in terms of M&A. And the reason for that is that the really big mining companies have all signaled that copper is a strategic mineral for them going forward. And obviously they're doing their own exploration, but in many cases what they opt to do is simply buy companies that have already found, attractive projects and deposits. And in many cases, what they do is just simply buy those companies. So we've seen a lot of M&A activity amongst the smaller cap copper miners. And we expect that trend to continue as copper remains, for many companies, a strategic focus over the coming years.
Yeah, well, I love copper because, like you mentioned, John, we've been mining copper for thousands of years. We use it for so many different things, whether you're building a house. But now, actually, we talked about electric vehicles and stuff. There are parts of the batteries that will be using copper as well, and people look at the health of the copper market as kind of a look into the overall economy. People call it Dr. Copper. So I'm always watching the copper prices. It's one of my favorite metals to track. But John, this has been a great discussion. We're going a few minutes over here, so I want to wrap up. Do you have anything else you'd like to add to our audience before I let you get on with your busy day?
Yeah, I would just maybe wrap up by also highlighting uranium, because it's another very interesting metal, and it's been a really great performer this year. It's been the bright spot amongst commodities this year, with the price of uranium being up about 70%, believe it or not, this year alone. And even with these very strong gains, we remain very constructive longer term on uranium. And we have a number of different funds that are focused on uranium that invest in physical uranium itself, as well as across the whole uranium mining spectrum. So those are URNM and URNJ, and OTC is SRUUF.
There you go. Well, we're going to put all those links, to Sprott, if you guys want to learn more about these funds, in the description, in the chat. John, again, can't thank you enough for joining us today. It's been a great discussion. I like uranium too, but it seems like there's just been there's all this overhead pressure almost of like, are we going to actually see some adoption of nuclear energy? I guess, could that be the hot take you leave me with? Do you think in our lifetime we'll actually see some more adoption of nuclear energy throughout the United States?
Well, the United States is going to be, I think, a real challenge in terms of building more large scale. But, where the growth is coming from is obviously places like India and China that are very focused on expanding their, nuclear capacity. And that's where we see most of the growth coming from.
Yeah, I got to say real quick, I was in visiting a friend in a suburb of Chicago not too long ago. And I guess there's a nuclear power plant near there that was in talks of getting shut down. When you drive through their neighborhood, I guess they employed a lot of people. This plant employed a lot of people. Every single sign or every single yard had signs in the yard that said like, "Save our nuclear power plant." I was like, maybe this isn't as unpopular as like people make it out to be. Like we'd be down to try a few things, but maybe not in the United States. Like you said, maybe in more of the developing countries is where we'll see some of that adoption.
Yeah, and by the way, those two power stations in Illinois were saved and extended. So
well, there you go. This was a couple years ago. Yeah, I don't know. I mean, that this was on the. I always made me think of it. So that's good to know. All right, I'll text my friend today and say, hey, I heard all your neighbors kept their jobs.
Exactly.
All right. Well, John from Sprott Asset Management, again, thank you for joining us. Hey, I'll let you get on with the rest of your busy week.
Thanks for having me. Take care.
All right, guys, that was John Ciampaglia from Sprott Asset Management. If you guys want to learn more about those exciting ETFs, really cool precious metal and mining ETFs, so go check that out, Sprott. I'm going to bring my man Money Mitch back on the screen. Mitch, how we doing today?
What's up, man? Ready to get after it. Of course, you guys caught my earlier interview with ER shares, but let's keep it going. Got a lot to get into. It's always good to see you, AB. I'll kick it off here. Let's get right to the action. Of course, Benzinga is all about what? Leveling the playing field, of course, for everyone out here. This is why we have on today, of course, Sylvia Jabanowski, CEO and CIO at Defiance ETFs. I'm throwing up the link right now so that you guys can follow along with us as we go through the interview. It's good to see you, Sylvia.
Great to be here. Thanks for having me.
All right, let's get to the action. Of course, when we're talking about ETFs, I want to have multiple opportunities, right? And I think that that's very important to have access to. So here you guys clearly see all the ETFs that Defiance has to offer. You guys click that link and definitely follow along. But let's talk a little bit about this, right? When we talk a little bit about investment opportunities, I'm always looking for different strategies, right? Can you elaborate on the strategy, of course, of selling option premium? And that on a daily basis to generate outsized monthly distributions. What kind of ETFs does Defiance ETF have to offer this that could potentially deliver those outsized income?
Yeah, great question. And so I think, you guys have been covering ETFs forever and doing a great job of it. And as you know, every couple of years, something new, a great new innovation tends to come into the market. People figure out new ways to do things. And, the last couple of years have arguably been about generating cash or dividends in one way or another, particularly around, market volatility and things like this. So there were a couple products that have been around for a while that use covered call strategies on a monthly basis. They invest in an index, call it S&P 500, and then use a covered call strategy to generate outsourced income or outsized income. And they come back with a tune of divs between 10-15%, something like this. Other ETF companies have done it on single name stocks and have had much higher income amounts and things like that. So we started looking at this with our partners at Title and Zega. And what we realized is that, all of these products using covered call strategies are actually doing a great job providing this income, but they're kind of limited in their upside. And so about a year ago, a little more than a year ago, SIBO listed 0 DTE, so 0 day to expiry options. So essentially, they're options that cash settle in a day. They're European index style types of options. And so what's interesting about that is instead of doing, say, a covered call strategy and holding an index where, you start with, like, if it's S&P 1.4% div yield and then whatever you get on your covered call, we start with cash and treasuries. So it's a covered put strategy. And the cash and treasuries sit in the 4.5 to 5% treasury type of, return. So right away, you're kind of in a higher income environment. And then every single day, you have this chance to capture extrinsic value and intrinsic value based on the index move and also the premium that you gain from selling slightly in the money options. So to simplify this, every single day we sell options on NASDAQ, on S&P 500, and on the Russell that expire in one day. And every day we tend to capture between 0 and 1% of extrinsic value on just selling those options at baseline. So if nothing happened to the index, if NASDAQ didn't, we'll use NASDAQ as an example. If NASDAQ didn't move, and every day on average, we're able to generate, call it 25 bips, which is kind of a reality based on what we've paid our last 3 divs on, an investor would receive a 60% dividend yield on that. Now, the risk or the downside is obviously if the NASDAQ goes down, you lose, right? You lose on the price decrease on the NASDAQ itself, but it's a little bit buffered probably by, what you get. So for example, if NASDAQ is down 1.7% on a day, maybe we're down 1.4% on a day because of that yield that we captured. The flip side of it is you can also capture some intrinsic value. So the distance between the strike price and where the index ends up closing. So it's capped on the upside. So if NASDAQ rallies 20% today, we'll probably only get 1% or 2% of that. But if you think about that and how it plays out, you could, and how markets typically are, right? Just in terms of, yes, we have these outsized moves sometimes, but most of the time, it's been kind of pretty steady price action and low volatility as of late anyway. And so I'll just give you an example. QQQY is the NASDAQ product. We just announced today that this month's div is 60%. JEPY, JEPY, is going to pay out to the tune of 40%. And then IWMY is paying out 70%. So, and the 2 months prior to that, you can see it on our website, we're around that, right? So yeah, the goal is to really get creative with having the opportunity every single day to generate premium from selling slightly in the money puts. And we've been out for a couple months now, and they've gathered about 300 million in assets. It's like one of the fastest growing ETFs that I've definitely seen them in my career anyway. And yeah, there's just great appetite for this. And some of our, competitors and friends at, whether it's Yield Max and JP Morgan, they're doing different versions of this. And, people really have an appetite now for these outsized income products.
Love to see it, and probably not as good as the flagship ETF, but we'll get to that right now in just a second. Let's talk a little bit about an interesting one, which is cruise, right? I mean,
Yeah.
this is definitely another strategy that you guys offer, and dare I say, we're leaving the port for this one, guys. But tell us a little bit about it, right? It includes cruises, hotels, and airline ETF. Let us know a little bit about cruise.
Yeah, so Cruise was launched on the back of the idea that after the pandemic, people would probably, want to get back into the world and travel, right? And so that's exactly what happened. We built this ETF that gives you access to the largest airline, hotel, and cruise stocks by market cap in an index. It's basically based on that. It was based on the travel and reopen idea, and now it's just continues to get a tailwind from the fact that consumer wages are strong, consumer spending is strong. Spending has gone a little bit from goods to services in the last year or so. Some of these cruise lines have had epic performance this year, actually to the tune of 90% or higher in some cases, just off of the recovery. And yeah, I mean, just Thanksgiving weekend, 55 million people got out and traveled. TSA is seeing increased visits to the security stations on a day-to-day basis. I think 10 days in a row, they saw record year-over-year numbers. And so, anyone who sort of gets on a plane or gets on a cruise probably has a flight that's associated with that or a hotel that's associated with that. And we just thought it was a really great way to round out the, getting out there on the world trade for advisors.
Yeah, and I love it because it gives us kind of a little bit of collection, right? I've heard of different ones in the past that have been like the airlines or maybe the cruises, but combining them all with the hotels, I really like that perspective. I always look at these three areas, right? It's a lot of it is just leisure overall. And I think it's something important, especially when we're kind of focusing on the consumer, like we have been focusing in the overall market right now. Let's move over to, of course, Defiant's Quantum ETF. And this one I've always thought has been interesting and definitely one of your best performing ETFs. So you guys can definitely check this one out. Of course, we're talking about QTUM. So definitely check that one out, team. What could you tell us about this one, Sylvia?
Yeah, so I mean, I can keep this quick and simple, really, but there's just been a massive boom and popularity growth in the idea of artificial intelligence. So we launched this well before the Microsoft, ChatGPT investor news came out this year. We thought for a long time that there would be this innovation in technology that would include digitalizing factories to replace workers, creating smart cities, improving drug companies' ability to access data and gather information, robotics and surgeries, things like this. And so we thought, and all of that started taking off kind of on its own anyway. And then I think it sort of morphed into the AI trade, right, this year. And so what is AI? AI is essentially, something that runs off of a lot of data, a lot of, communication technology. It runs on supercomputers, quantum computing, parsing information, human language generation and interaction, things like this. So we just thought about, if as AI grows, what goes into that? A whole lot goes into that, right? So it's everything from the semiconductors to kind of the computing companies, the classic companies like IBM and HP that are actually leaders in quantum and supercomputing. It involves, visual graphic companies and software companies, cybersecurity, things like this. So our ETF just gives you exposure to the true, AI machine learning phenomenon that we think is just going to massively grow in the next 5 to 10 years.
Yeah, it's so important to try to be with those. And you guys have been advanced. I mean, I remember interviewing you.
Yeah, we talked about it a long time ago. We did. Yeah.
And it's important, right? I mean, I always talk about, like kind of like the bell curve of approach to things. And I always say technology comes in waves, right? And if we can be part of those early adopters before things get really massively adopted, I think that's really how we find a lot of the thematic themes that we're all looking for in investments. Would you agree, Sylvia?
Yeah, absolutely. And the way that we think about it too is like we try to make it more of a pure play, right? So the companies, when you think about investing in AI, a lot of people are just going to pick NVIDIA, and that's great. It's a, one of my
Yeah.
favorite stocks. It's a winner, but there are many companies that are kind of invested in this space and growing in this space. And some of them are tiny small cap names that you're not even thinking about right now that might get acquired or might, kind of blow up with a new technology. And so I think like having a basket where you have those classic Googles, NVIDIAs, AMDs in there. You obviously need to see those names in there, but getting some of the smaller, like small cap growth tech stocks that are going to potentially have their heyday with that hedge of the large caps is an interesting way to go about it.
Love it. And it's always good to go through different opportunities. I hope that you guys checked out some of these. I've thrown up the link there twice for you guys to check out all these ETFs. It's great to have you on today. Sylvia
Thanks so
Jabanoski,
much.
CEO, CIO, Defiance ETFs. Don't miss it, guys. Thank you, Sylvia. All right, guys, time to keep it going here. Of course, it's a action-packed day. We're going to keep it going. We're going to bring on Zunaid back. He's been killing it. Of course, you guys know how I refer to Zunaid, the freshest fade on Wall Street. What's going on, Zunaid? How we doing?
You say that, which only makes me want to go get a haircut right after the fact. We'll get one, but what's up, man? I appreciate all the different insights that you provide on the ETF side. Definitely going to need to check out the AI ETF that Defiance has there.
It's always great, right? Let's continue leveling the playing field for all those investors out there. Keep it going, Zunaid.
Absolutely. And of course, if you're going to make money, Uncle Sam wants a little bit of it. And I wish I could introduce my next guest by saying Jerry, but we like to be professional. So maybe we won't do that here. But coming up next from Traders Accounting is going to be our lovely tax accountant, Jerry. Let's go ahead and bring him on the show. Have you ever been introduced like that with like Jerry 3 times? I got
honestly, no, I've never heard that before. So you're original.
I appreciate that. And Jerry, you may not remember this, but I'm going to jog your memory. You and I have actually had conversations 3 years ago because I reached out to you guys about setting up my LLC because I'm a trader. I had a partner in Argentina, so I didn't know how to go ahead and make sure that was all. See, it was one.
I do remember that.
There you go. Look at that. Well, hey,
Yeah.
It's great to put a face to the name. I'm glad we're getting a chance to have this conversation. There's so much to talk about, but I know who you are. I know what y'all do. But for the folks at home that are watching, go ahead and give us a little bit of insight on what is Traders Accounting and how can they take advantage of your services.
Well, Traders Accounting is an accounting firm that exists really primarily for people who trade. If you set up an entity or if you trade as an individual, we can do the tax return. We can do consulting for you and tell you how to structure things. We can set up entities, or if you have an entity, we can do the bookkeeping for it as well. So we are a well-rounded CPA firm that provides a lot of services to support traders and, as the theme is, level that playing field for everyone.
Yeah, now you provide a lot of great insights and you have a lot of different perspectives as well, especially with today's conversation, given the size and the scope of the clients that you work with on a daily basis. So I'm curious if you have any insights on your current take of the markets as they are at the moment and what your thoughts are as we head into December and look ahead into 2024.
Yeah, my view of the markets, and I was watching yesterday's market yesterday, obviously, and it was a very unsettled market. It was up and down and up and down. Today, obviously, it's really strongly up. What I'm seeing in the market is a lot of hair triggers. I mean, obviously, the market is looking at inflation and whether the Fed will raise interest rates, or if they're done raising interest rates, and you start seeing, well, this Fed chairman or this Fed person says this, and this one says this. And so they get skittish about stuff like that. There's other things going on out there. You got the world situation. Certainly, there's some people are concerned about the M3 money supply and how that's taken a rapid drop. So there are things out there for concern. Obviously, we're in December, which is normally the Christmas rally. So people are taking advantage of that. Some of our traders take December off. And one of the reasons for that is to wash out all those wash sales from their account and make them regular losses. So there's things going on that we're keeping an eye on. And then, of course, next year, it's just you got to keep an eye on the economic news. That's what's really driving everything right now.
Yeah, I mean, so much of the conversation is behind, interest rates and what's the housing market going to do. And of course, you've got AI that kind of impacts a lot of different stocks as well. Let's go ahead and dive into something that we've talked about earlier in our pre-call and our rehearsal, if you will. You mentioned tax implications related to ETFs. Now, of course, with this being all about ETFs today, we wanted to see how it would be useful for you guys to provide a little bit of insights. What are the best way that you can go ahead and take advantage of ETFs on the tax side?
Yeah, ETFs are actually great. And I like them personally from the tax side. However, you have to be careful because there is a surprise there that can happen. And let me kind of back up and talk about general tax structures. Most people know that if you trade stocks and options, that's a capital gain if you make money there. But if you're trading futures, that's a capital gain, but there is a special tax situation where 60% of that gain is a long-term capital gain and 40% is a short-term capital gain. Okay, so fine. When you go into futures and you go into stocks, you know that stuff. Well, ETFs mostly are treated like stocks. So whatever you make is capital gain. If you get a dividend, it's a dividend. However, some of our clients have been very surprised and a little confused because some ETFs that are traded on the Chicago Board of Trade are actually treated like futures for tax purposes. And so they get into that 60-40 split. Now, why is that a problem? Well, one, it's the shock of everything. And let me give you an example. SPX versus SPY. Most people think, oh, they're the same thing, and they're traded exactly alike. And to some extent they are the same thing, but tax-wise, they're completely different. SPY is traded on the New York exchanges, while SPX is traded on the Chicago Board of Trade. And the reason I mentioned that is if you are expecting a stock situation or an option situation where you've got a capital gain and you may have the mark-to-market election or you may have some particular structuring, and all of a sudden you've been trading SPX and now you find out you're in the futures side, that can be quite a shock and can actually influence the tax bill and vice versa. So it's very important to understand where the ETF is being traded, and that will determine the tax implications it has for your trading.
Yeah, and of course now you've got prop firms that are a big part of the trading world as well. And I think they spit out 1099s. You would know best, but that's a whole different element that has now been introduced in the past year or two.
Yeah, prop firms have grown tremendously. For those who aren't familiar with them, prop firms, basically you go in, you invest some of your money, but they also give you a pool of money of theirs to invest. And then, as you're right, Sinead, they will give you a 1099 at the end of the year. Well, how does that affect your taxes? Well, what happens instead of a capital gain or a capital loss or however it normally happens with stocks, options, or futures, you now have self-employment income. So normally with traders, your gains or losses are just subject to income tax. And that's it. But self-employment income now is subject to income tax, and you have to pay self-employment tax, which is an additional 15.3%. So that can come as a rude awakening. And I'm afraid, we're coming up on tax time. I'm afraid there's going to be a few people that kind of wake up here in the next few months.
Yeah. So let's talk about that, right? Because there's so many different things that folks don't know about taxes until it's a little too late. So how can the typical investor reduce taxes, whether it's through an LLC, turning into an S Corp, all that good stuff? Give us a couple of nuggets, because I know you've got so much insight on how the average Joe can reduce their taxes.
Sure. There's a couple ways that things can happen. One way I mentioned a little bit ago that some of our investors, they trade personally and they take December off. And you may be wondering, well, how does that save in taxes? Well, one of the reasons, if you're familiar with wash sales, with stocks and options, wash sales are basically deferred losses. And I won't take the time to go through that right now. But at this particular time of year, if you're continuing to trade, a lot of your losses in 2023 get pushed into 2024. And so it's very possible you may end up paying taxes on things that you lost money on, quite frankly. And I've seen people lose money in accounts and still end up paying taxes because those losses got shifted to the next year. That's one strategy that some people do, is they just take December off. Another strategy is to make the mark-to-market election. Now, this is for stocks and options traders, but the mark-to-market election gets around all the wash sales. It's actually a valuation of the account that you have. So you start with a beginning balance, you have your ending balance in your account. And really the simple way of thinking about it is the difference is what you pay tax on. There's no wash sale stuff, nothing like that. Third way is entities can be very beneficial. We avoid a single member LLC because one of the reasons that people do a single member LLC, they think it's going to help them, but it puts it on their personal tax return where the IRS starts to notice them. So we try to do things, get it off your personal tax return. And when you get that off your personal tax return, the IRS takes less notice of you. It also opens up tremendously the home office deduction. If you try to take the home office deduction on your personal return, there's a lot of limitations there. And sometimes you can't take anything, sometimes a little bit. But if you go into like a partnership or an S corporation, that whole thing opens up, and then you can take a percentage of all your home expenses at that point.
Yeah, and I think that's so key because I've got 4 monitors here. I got pretty lights to make me look nice and handsome. So yeah, you want to deduct all those things as much as possible. We've got a few more minutes here, but what are some things that the investor should kind of concentrate on? Is it, hey, let's go ahead and set up your LLC so you can trade best? Or is it, hey, like what are some, let me rephrase, what are some common mistakes that traders make that you were like, hey, I wish you came to me beforehand?
Yes. Let me start with one of the biggest mistakes, and the one that I've been really super concerned with over the last couple years. Most people remember at the end of 2022, the AMC GameStop debacle.
Absolutely.
And people made tons of money in December of 2022. The problem is they lost it all in January of 2023.
Yeah.
And so I was consulting. I lost count of how many people I was consulting. They said, I made all this money in December 2022. Now I lost it all. What do I do? And unfortunately, I had to bear the bad news to them. You got to pay the taxes on that 2022 stuff. And then try to recover it eventually over the next few years. So I say all that to say this, as you're trading, most people have a definite plan for trading. You've got a plan, you've got the emotion out of it, you know what you're doing, and that's fine. You need to link that to a definite tax plan as well. Because if you just trade and earn a bunch of money, then all of a sudden, here we come April 15th, now you're looking at a huge tax bill that you never planned on. So my recommendation to my clients that I work with is take some of the money once a month, once a quarter, put it back 25, 30%, put it back for taxes so that when it comes tax time, you've got the money sitting there to pay the taxes. And if you don't use it, you can always put it back into trading. So that would be one way that I can recommend that. And they just flashed the link up on the screen here. This link, if you go to our website, and I'll get this in real quick. If you go to this link, there's a free ebook that we have that talks about entities, that talks about everything I'm talking about today, and so much more. You can get that for free. There's no obligation whatsoever. And then if you can read through that, if you want to make an appointment with us for consultation or something, feel free to do that as well.
I cannot. I'm sorry, go ahead.
No, I'm sorry. Well, the ETFs, let's go, or not ETFs, but entities. Let's go back to that for a little bit. Another strategy right now that I have been working with some clients with, particularly in the last week, is setting up an entity by the end of the year. Now, remember what I said about the wash sales and diverting those and how you can just take December off. Well, some people don't want to take December off. Quite frankly, you want to keep trading.
Right.
Well, if you set up an entity right now and you get your trading assets into that entity and make the mark-to-market election, then let's say it happens today or tomorrow or even at the beginning of December, then your personal account that you've been trading in sits dormant for the next 30 days. And those wash sales clear out again while you keep trading in the LLC under the mark-to-market election. So that keeps the ball rolling, and it gives you the benefit of getting rid of those wash sales for 2023.
That makes perfect sense. And I'm glad that we had this conversation. There's so much that we can go ahead and discuss, but I absolutely encourage every single individual, whether you're starting to trade, you're a professional trader, if you don't have someone who helps you with your taxes, to reach out to Jerry and the team. Jerry, give Rivian my love. Absolutely love you guys over there at Traders Accounting. And I'm sure we'll be talking here in 30 days or less.
All right. Sounds great. Nice talking to you. I'm glad you guys had me.
Absolutely. And chat, thank you so much. And again, cannot emphasize this enough. You want to make sure you take advantage of the tax structure so you can save taxes legally. Now, we're going to go ahead and keep it moving here. We are going to go ahead and bring on my man, Daniel Santiago, who is the Vice President of Vantage Point Software. Let's go ahead and bring him on. How's it going, Daniel?
Hey, good. How are you?
I am doing well. I appreciate you for taking the time to hang out with us. I mean, we've been talking about ETFs. We've been talking about rotations, trying to follow the money. I know you've got some good stuff for us, man. So the show is all yours.
Yeah, I appreciate it. And let me just say thank you for having me on. You guys are doing so much at Benzinga to help traders and investors, and giving me the opportunity to share a little bit about how these ETFs can help you follow the money. I think is an important thing for every trader to think about. So thanks for the time. I'm going to share my screen really quickly here. Just to give you guys, I got a couple slides, a little bit to dig into the details.
Yeah.
Here we go.
And while you go ahead and pull that up, I think it's definitely important. You want to follow the money, follow the whale, whether it's in the sports betting world, the ETF world, the stock world. You want to know where the big money's at. So I'm listening, man. The show's all yours.
Yeah, I appreciate that. Thank you. That is true. Following the money. I mean, when it comes from a momentum standpoint, following the money will bring some momentum to your trades. And one of the things that I want to talk about today are how you can use ETFs, whether you're an options trader or a stock trader. Doesn't really matter at this point. ETFs can give you some extra confidence and some benefit. Just a quick reminder, though, even though we're going to be talking about trading and digging into the details, trading is hard. It involves risk. Everybody knows that. I'm going to talk about some things that some traders have used to be very successful. Just a reminder, the results may be atypical, and I've verified it. You guys know what I'm talking about. But back to the ETF conversation. One of the things that I want to do is we've been talking about ETFs. You guys have for a long time now. You know what ETFs are, but there's a specific definition that I want to pick apart. And then we're going to dig into the details, how to use the ETFs to confirm trades, and how ETFs can help you identify sector rotation as a stock trader, as an options trader, all very, very important topics. Here's the definition we're probably all very familiar with of what an ETF is, right? It's an acronym. It's a fund that can be traded on an exchange like a stock. The second half of this definition is really where I generate today's topic from. And that is the fact that if you stop and think for just a second, that an ETF is a basket of individual assets that are owned by that ETF, or stocks, if you will. You can break apart that little statement of buying and selling a basket of assets without having to buy all the components individually. Break that down. If enough of the individual components in that basket increase, the share price of the ETF increases. I think we're all pretty familiar with that concept. But I like to flip that sentence around and think of it like this. If the price of the ETF is increasing, then the price of the individual components are increasing. Now, there's some assumption there, but logic drives me to the point that if that's the case, and I'm an individual stock trader or an options trader, then that means I can use the movements of the ETF to gain confidence and understand where that stock is expected to go. Let me show you. I'm going to bring over here, and the software that I use is Vantage Point. This is Vantage Point software. It's an artificial intelligence driven software. And what I'm looking at right now is CrowdStrike Holdings. This is a stock. We've got about 3 months of data pulled up here. And I want to direct everybody's attention to right here. This is a crossover, we call it, where the blue line is below the gray line and then it crosses above it. This in the software is where the artificial intelligence is saying, hey, new uptrend about to start in the next couple of days. There's some great opportunity in this stock. We also have this green bar down here. This is called the predicted neural index. And I'll get more into the software at another time, but the details here are saying this stock, based on the artificial intelligence forecast, is expected to move higher. Well, that's for any trader out there, any stock trader, options trader, that's what you want to know and when you want to know it. Well, before you jump in, you got to be convinced that that's the right move. And that's where I turn to ETFs like this, CIBR. This is the First Trust NASDAQ cybersecurity ETF. CrowdStrike Holdings is a cybersecurity stock. Well, if I get a crossover at the same time on the ETF that stock is likely part of, and in some cases is part of, that really inspires some confidence. You want to talk about confirming some trends by understanding that the ETF or the sector or the basket of individual components is moving higher. That's how you do it. And this is a great example of where on November 11th, you can see that crossover happened. The second it's confirmed, it's good to go. If I go back to that CrowdStrike, the same time we see that crossover, November 1st, November 2nd, it's ready to go. I've got not only the artificial intelligence in CrowdStrike saying that this trend is expected to move higher, I've got the ETF that CrowdStrike is part of saying, the AI is saying that is expected to move higher as well. Talk about confirmation, talk about confidence. This is how you can do it with your ETFs. And in the same case at the exit. Now, we don't have an exit point right now, but if you were to take advantage of this, the artificial intelligence in this stock is saying this trend is expected to move higher. I know that because the blue line is still above that gray line, that shaded area is green. It's pretty easy to interpret. But what this means is that this trend is expected to move higher and able to capitalize on a substantial move that happened just yesterday, right? So this trend that was identified with the AI, confirmed with the ETF, here's the potential gains. These are hypothetical, but look at this, almost 30% gains. If you had taken advantage of this at that time exactly, well, then these are the kind of gains you can expect. Well, let's go over to the ETF really quickly, Zainab, take a look at this and see that this ETF had the same move at the same time, identifying that CrowdStrike position had bullishness, had momentum, had support with a cybersecurity ETF, again, inspiring that confidence. This is one of the things that we teach at Vantage Point Software about using this AI in conjunction with ETFs to get that confidence and take advantage of these big moves. And it's not just cybersecurity.
Now, real quick, I just, one thing I want to make sure that I understand, and so the viewers understand as well.
Yeah.
You're not an ETF. You're the one who looks under the hood to see, hey, what is going on? Where's the trend? Where's the money coming in and out of? Do I have that correct?
You have that correct. We're a software program that's identifying trend reversals up to 3 days in advance with accuracy up to 87.4%. It's Vantage Point Software. Our website is vantagepointsoftware.com. But better yet, for everybody that's listening here, you can go to etftradingtool.com and check out really in-depth education. I'm doing a live webinar tomorrow. We're going to dig in deep on these concepts, but you have it right. This tool identifies whether you're talking about stocks, ETFs, futures, Forex, cryptocurrencies. It identifies these trends in advance, helps traders with timing on entries, exit, position management. And when you can combine a tool like this with the use of ETF to confirm positions, you're stacking the odds in your favor. You're gaining that edge that's necessary. And we all know trading is a dog-eat-dog world. So you've got to you've got to have an edge, right?
Yeah, no question. I know you've got a couple other points, but I also see on the left-hand side, you've got futures, Canadian stocks, crypto, and different things like that as well. So if I'm understanding this correctly, you're not just a one-trick pony in terms of just stocks.
That's right. That's right. Not just stocks, not just ETFs, options traders. I got to tell you, from an options trading standpoint, now, if we go back to CrowdStrike Holdings, if you're looking at this and trying to figure out if it's time to buy a call or 5 calls or 10 calls, and you've got that analysis that I just did, and you set your expiration out, let's say 60 days, you can see that you're capturing the majority of this. And with the leverage and options, it's a very, very powerful move. So you've got it right. We're not a one-trick pony. Our software, the artificial intelligence, is able to predict in all of those different asset classes. And you know, from a futures standpoint, we're talking about 72 individual futures markets forecasting.
Yeah. Cool. Got it. Well, keep on going, man. I was just trying to make sure I was good.
Yeah, I'm glad you are. Thank you. And stop me anytime. You know, it's important that you and the people listening and watching understand what this is and how it works for them. The earlier I was listening to, you know, the program about some of the ETFs, and we're talking about gold and precious metals. Right? The Gaby was going into the details about that earlier. And when you look at this, here's IM Gold. This is a stock. Same idea. You see a fresh crossover here, right here on the right-hand side, 1117. Well, this stock, has been somewhat volatile. You can see from the candles, there's some volatility there. Well, if I go check the ETF at the same time that the artificial intelligence is saying that IAG has some bullish potential over the next few days, if I get the same indication at the same time, you can see that there's some great confidence in that. So there's a lot of really powerful things that you can do by simply understanding that stocks can be part of ETFs, and not only using the artificial intelligence, which is already a leg up, but going and checking that ETF for major moves like this and then capitalizing on those trends in advance, especially when we start talking about support and resistance. A lot of you traders out there that use support and resistance can probably very easily see a resistance point here at around 1655, let's call it. Well, if you're looking at Barrick Gold and wondering if you're in this bullish trend, wondering if that stock has enough momentum, has enough volume, has enough push to get past that resistance level, which, let's be real, that's a question we probably all face is there enough, especially with the fact that it failed off of that resistance point here. You can see we barely got a close at or below that resistance point. Well, at the end of that day, it's a question. Is this thing going to keep pushing higher? If I go to GDX, which is the ETF that I can use for Barrick Gold, I can see the same situation happening on GDX. The difference here is that the entire sector, or the ETF that's following the gold miners, has major bullishness. That blue line is pointed up. It's got a very positive slope. All my indicators are green. Even that resistance level has been tested and maybe even beaten. Regardless, I've got two forecasts in this artificial intelligence software saying the same thing. They're saying bullish, and these forecasts aren't generated just by looking at the stock by itself. They're generated by the AI looking at global markets. So when you combine that, and if anybody has any questions about what I mean when I say global markets, just go to etftradingtool.com and sign up for the live training tomorrow. I'm doing a full in-depth training tomorrow about what I mean by global markets and intermarket analysis and how this works. But when you look at this ETF and see that at the same time, and I'll put them side by side for you, at the same time, here on the left, we've got Barrick Gold. On the right, we've got market vectors, GDX. Same time, bullishness. There's no question in my mind that resistance level is gonna really struggle to stay, and we're expecting it to beat it and break it. If you had done that analysis and walked through the details, I'm gonna roll that chart forward on Barrick Gold really quickly and show you what happens after that. That's the confidence. Now, this isn't going to happen every single time. This is a home run of a day on Friday. So let's be real about how trading works. But the confidence to hold that position, even though you're up against resistance that cause price to fail, can help you find more of these things more often.
Well, I'm looking at your software and I'm seeing all the different things that you have. I know you also have the home builders and things like that. So that's, we talked about how you have different sectors, right? So whether in 2020 you were like, hey, airlines are going to be down, or hey, I want to go ahead and play it on the uptick, or hey, AI is like something that I want to be invested in, EV space in the future. You can truly kind of see, hey, here's a trend. Here's where the money's kind of going. And what I really like is what you mentioned at the top is you can time it up if there's a stock that you like as well. It gives you a bit more of a confidence of, hey, CrowdStrike individually I like. It looks like the ETF is moving up as well. Looks like the other companies within that same space are doing well. Therefore, you get that sympathy moving on over as well. So this is fascinating, man. Before I let you go, though, any final thoughts?
Yeah, one of the other things I wanted to talk about is that sector rotation piece. I'm going to flash this on the screen really quickly because I think it's important. Sure. You just said something that really, as a trader, a lot of traders struggle with. I'm going to open a tool that we call IntelliScan. I'm going to bring up a sector scan. And one of the things you can do to follow the money is scan on the ETF. Now, in the software, we have tools that use AI to scan, but I've got a lot of the sector ETFs in here. There's 14 different assets in here. Now, all of these columns, I'm not going to dig into the details on these today, but when you see up, that's the AI saying this trend or this market or this price is expected to be higher over the next 1, 2, or 3 days. I can boil it down really simply and see there's a lot of green on the bottom half of that. As a matter of fact, the financial sector spider, XLF, has a lot of green across the board. And over the next 10 days, the AI is saying the seasonal performance could produce 1% or more. Well, that leads me to say, if I'm looking for a new asset or a new stock today, the financial sector ETF has a lot of opportunity. I don't know about you, but for me, when I think financial sector ETF, I think of Bank of America. So I'm going to go to Bank of America really quickly and just open that chart because the sector says it's looking pretty good. Here's Bank of America, a really nice, great trend. But more importantly, this is the updated data from last night at 6:30. This analysis that I just did, that quick scan that we did together, said Bank of America would be expected to go higher today. Some strength in that trend, some strength in that price. And I haven't looked at Bank of America yet, but if I go look at Bank of America right now, based on the analysis that we just walked through, I'd expect it to be higher today. Let's go. I don't know if you have it there, or I can pull it up really quickly.
Well, here, let me just kind of pull it up here. We've got, what is that? BAC.
BAC.
It's great whenever you're talking to friends and stuff. They're like, "Oh, what do you think about Bank of America?" I'm like, "Oh, BAC. Yeah, I know that stock." That's just how you kind of have those dinner conversations. But Bank of America is up.
Yep. And we knew that based on the analysis, we expected it, but also check this out. We didn't go into too much detail on this. I'll do some more of that tomorrow in that live session if you guys go sign up, but this is a predicted high and a predicted low. Yeah. The artificial intelligence every night at 6:30 is going to present to every trader, every user that has this software, the expected high and low for the next trade day. Well, the fact that it's shaded green tells me not only is the ETF, financial sector ETF, higher, Bank of America is expected to be higher, and the high and the low are expected to be higher than the previous day. Got a lot of confidence opening the day today saying, hey, you know what? Maybe I go find some zero DTE options on Bank of America because I'm expecting a big day today. Or maybe I'm just in this position and I can move my stop, close my computer, go ride a bike or do something fun like golf today because I got all the confidence that Bank of America is expected to move higher. And that's what Vantage Point was designed to do. And when you combine it with the work around ETFs and the extra confidence, talk about a lot of really, really strong moves that you can take advantage of. It's great.
Absolutely. No question about it. Got to follow the big money. Thank you so much, man. I appreciate your time.
Absolutely. Thanks for having me.
Absolutely. And that's Daniel Santiago, who is the vice president of Vantage Point. Check out the software. More importantly, if you like what you heard, just the nugget of it, just the appetizer, you can watch him go ahead and break it down all in the webinar. We have the links in the chat as well. So make sure you go ahead and check that out. But folks, I cannot, appreciate y'all even more for hanging out with us for this webinar. And I also want to emphasize just how important ETFs can be, especially for the average Joe, the average Jane who is working a 9 to 5 or works late night, but can't really dive into the stock market to pick out the stocks. And this is where you want to do your own due diligence, see which ETFs works for you, see what you believe in and what you believe the future is going to be. But this is a great way, ETFs are, in my opinion, to see how you can unlock and have your money make money as you have other opportunities in life as well. But that being said, on behalf of myself, or producer Mali, and all the men and women behind the scenes that make this possible, we thank you for watching ETFs Unlocked.